Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, I was reading an article in today's USA Today, which is nice and colorful, but they talked about, it's an interesting article because they talked about investing in stocks, and then it says in the byline, forget about it.
Oh no.
And the interesting statistic was back in 2008, you know, with the big stock market crash,
right,
and then the subsequent recovery. We've been talking about many episodes where there's been a net outflow of equity funds.
Right.
But what I didn't realize, and this was an amazing statistic, is back in 2001, statistically every household, 58% of every household either held individual stocks or stock mutual funds.
Okay.
Now, since 2008, as of this current year, only 46% own stocks and mutual funds. So what do you think?
That's really telling because we've had a recovery too.
Right. And the interest rates have kept going down.
Right. Yeah. Exactly. So when I first heard that, what I think is we often talk about different kinds of studies. We talk about the Dahlbar study, or we talk about outflows from mutual funds and all this other stuff. Okay, here's a really concrete, easy to understand statistic about how people do the wrong things with their money. When the stock market was at its peak, over 58% of homes owned some sort of stocks or mutual funds. Now, when did they sell? At the worst possible times. And now we're down to only 46% of households owning some kind of stocks or mutual funds. It doesn't get any more blunt than that. I mean, and Curtis doesn't necessarily get involved in these kinds of arguments, but on my internet forums, a lot of people argue that when we say that investor returns are lower for retail investors, are lower than the actual market, they say, oh, that's not really true, you know, those studies are biased, or they're making up numbers, or all this other sort of thing. Okay, well, we're not making up this number.
This is concrete proof.
This is just, you know, there's no way to get around this, that we've seen a massive drop in the number of people who are owning stocks at all, and they have sold at the worst possible times.
Right, and even though the market has recovered dramatically, in fact, it's up 102%, since the
bottom, right? They haven't gotten back in.
They got back in, and they've stayed out of it. So I guess you know, and the interesting thing is from the long-term ramifications, is that good for the stock market? That people, I mean, it's, from a cash flow and liquidity point of view, it seems like if past history repeats itself, they'll start dipping their toes back in after it starts getting up to a certain level.
Yeah.
Okay.
I mean, that's probably exactly what will happen. Those who stay disciplined will reap the rewards of long-term investing, plus the rewards of rebalancing by buying when things are lower, and those that don't stay disciplined will just take all the risk and not get the returns.
Okay. And I guess if we look at the future and trying to build a sustainable retirement portfolio, we truly believe that you have to have elements of equities or stocks in that portfolio. So if you in the audience have been scared out of the market or have materially changed your investment philosophy because of this fear, you should contact Lauren or myself to have a discussion about that.
All right.
All right. Thank you very much for this episode. We'll see you next time on Erickson TV. Bye now.
See you next time.